Hello and welcome to Portfolio Matters, weekly markets checklist, week 158. And great news, Richard is back. But before we get into it, he will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, Keith, what have we got this week?
Well, it's a packed week, but before we get going, pub night will be on Monday, the 24th of June. Put it in your diaries. Hope to see a few of you there. Now, news this week. Well, the US has imposed a range of new tariffs on Chinese imports. So 100% tariffs on EVs, 50% tariffs on solar cells, and 25% tariffs on EV batteries. So the US is cutting down on its trade with China. The EU has revised down its year-end 2024 inflation targets from 2.7 to 2.5%, in part because it said the disruption to trade from the conflict in the Red Sea has not been as severe as feared. But the big data from the week was US CPI, and US CPI came in slightly soft. Markets are off to the races on the back of expectations that Fed rate cuts are coming in H2. So the Dow yesterday hit 40,000 for the first time, briefly, and copper has hit an all-time high. Richard will be happy.
Apparently, I was reading the FT this morning, Keith. A lot of people say there's a short squeeze going on. So whilst there's an underlying trend, I believe, over the next few years, this is more of a blip, probably.
I agree. We'll take you through the COMEX data. Some charts related to the news. So this chart shows the number of expected rate cuts for the Fed by the end of 2024. And you'll see the story of this year is that the number of expected rate cuts have been falling as inflation proved persistent, but now it's starting to rise again. This is Eurozone inflation, and the ECB now expects Eurozone inflation to hit 2.5% at the end of the year. That's good news. And falling interest rate expectations have led to the bull market being very much back on. So the Dow hit 40,000 briefly yesterday. This is Chinese vehicle exports, and they're going through the roof. This is going to be very bad for the traditional export countries, which is Japan, Germany, and the US. And actually, the vast majority of these are not EVs. Only about 25 to 30% of them are EVs. But Germany in particular, I think its traditional dominance in global car manufacturing, together with Japan, will be challenged. And you've seen our cover photo, which is Roaring Kitty. He's back. And as a result, the meme traders in the US pushed GameStop up 30% it's more than that, isn't it? Huge amount in a day.
50,
It's suddenly come off a bit since then, but still, this is an indication of how much exuberance there is in the market, I would say. And this is the turnover of GameStop compared to its market cap. Absolutely amazing turnover.
There's only one category of person who makes any money out of this, isn't there? And that's the people who are pumping it at the bottom.
Yeah, absolutely. But also Wall Street. This is very good for Wall Street. They sell short at the top.
Yeah.
Copper gone absolutely ballistic. We will have much more on that later. And sadly, Russia has gone on the offensive in northern Ukraine and is taking territory as Western arms supplies have been slow in arriving. We will watch that, but the situation in Ukraine is not good. I thought this was good and sadly true. While we're talking about disastrous events, Donald Trump is now ahead on predicted. On to this week's economic data and quick summary. Well, we'll go through this, but I find the UK data absolutely incomprehensible. Is the economy strengthening or weakening, or is the data just bloody awful? We will go through it. The EU economy remains weak, but appears to have bottomed. Definitely signs of renewed industrial strength and certainly much better sentiment. The US economy is strong, but showing definite signs of weakening now. China, difficult to tell. Actually, the latest data show it doing okay, but not transitioning. So industrial strength, consumer weakness. Global manufacturing definitely shows signs of a cyclical upturn. But the most recent data in the US shows it failing to strengthen, having bottomed. Okay, on to the UK, Richard.
Thanks, Keith. So the UK unemployment rate, it looks like it's just in a slight uptrend there, doesn't it? And Onyx, but looks to me like there is a little bit of an upward trend there. And that's the employment change. So number of people employed. What's that telling us, do you think, Keith? I mean, trying to interpret where these bars are going.
Well, the thing is, Richard, this is data point one in the total incomprehensibility of UK statistics. So March, according to the employment change, we saw job losses of 178,000. That is a big number. Okay, so there are about 33 million employees in the UK. So that's about 0.5% of the workforce, isn't it? That's big. So how come how come the unemployment rate only ticked up by 0.1%?
And you can actually you can go back to last July, can't you? And that was probably near 1% in July and August. So that'd be 2%. And there's a little bit of recovery, but that doesn't feature in the stats either.
Yeah, absolutely. And over the last 2 months, you've had 330,000 odd job losses. That's 1%. That is a huge number. So how come unemployment's ticked up by, only a bit? Doesn't make any sense.
I agree. And can we believe the labour force survey? So as Keith points out, so this is showing larger falls in UK employment than the HMRC payrolls data, which is the grey bars. So, I mean, they have the national, what do they call themselves? The statistical office.
Yeah.
The National Statistics Office has really fallen over, hasn't it, on the employment statistics?
It has, yeah. Basically, nobody's filling in their survey anymore.
I know. And actually, it's interesting, they broadcast that actually one of the problems is nobody completes the survey. And I got a survey the other day in my official capacity, which he completed. I look at it and think, why should I bother filling this out? Because nobody else does. Why should I do it? It's quite onerous, actually. And you get to that sort of point, well, this system's broken, actually.
Yeah. Is it a paper survey, Richard?
Yeah. Yeah. And it asks all sorts of detailed questions. And actually, it's got a box for the pence. It's a salary survey. It's got a box for pence. You just think, who's doing this?
Yeah.
Well, you're putting someone's salary as X many thousands of pounds. And how many p?
Well, yeah, the state of the UK government, they're still sending out paper surveys.
Yeah, it's just dreadful. So the ONS calculates the number of UK job openings is continuing to fall, but is remaining above pre-pandemic level.
Yeah.
Just. And the number of payrolled employees in the UK is significantly above pre-pandemic levels.
Yeah. Actually, so when you compare the two,
3%.
The number of vacancies, yes, is higher, but then so are the number of employees. So, that suggests that the labour market possibly is not as strong as the vacancy number itself would suggest.
Yeah. UK average weekly earnings, oscillating currently between about 6 and 8%, and have been for the last 2 years. So this is a distinct inflationary pressure. And I have to say, the business I work for, we are seeing that, and it is problematic.
Yeah, no, this is bad. This is really bad.
Change in behaviour.
Yeah. So can you expand on that, Richard? So what are you seeing?
Well, we're seeing consistently higher for new people. We're seeing consistently more money demanded,
Right.
and so you can't. The sort of the negotiating point is much higher than it was, and we're having to give fairly substantial pay rises when pay rises come due because inflation has been so high. And effectively, in the last 2 years, people are 20% worse off, especially that category of they maybe 25 to 35-year-old people. That's where they are in their career. They're 20% worse off if their salary hasn't gone up by 20%.
Yeah. Well,
and ignoring any tax increases. So I actually think there's a huge degree of complacency about inflation, and everybody's saying we're going to be able to do interest rates, and I'm just not convinced by it.
Right. Well, the wage numbers are much worse than expected. Expected to fall, and they're just not falling.
Yeah. And this is average weekly wages excluding bonuses, and basically it's showing the same picture, isn't it?
Yeah, just not falling. And if wage growth continues at these levels, I just can't see the Bank of England cutting, and certainly not in June. These numbers need to come down. Inflation can't come down when you have wage inflation this high. Simple as that.
Agree. Yeah.
So I've downloaded the latest wage data from the ONS, and the table you can see shows the annualized rate. So 1 month change annualized for total pay is 7.3%, for regular 9.9%, the 3 month rate 7.4 and 7.2. These are numbers just aren't coming down. So it seems actually, if anything, wage growth in the UK is resurgent rather than falling. Now, we know there's a very strong seasonality in the UK economy. So perhaps after we get April out of the way, wage growth will begin to slow. But April is likely to be a bad number because, reminder, minimum wage rises by 9.8% in April.
That's enormous, isn't it?
Yeah. So this is the UK claimant count, and it has been rising for quite a while, but every month is subject to revisions, and these are not large numbers in absolute terms. When you're talking about 33 million people employed and a 9,000 increase in the claimant count, that is not a big number. And it rather contradicts the, 180,000 people who lost their job last month, according to the Labour Force survey.
Doesn't it? Yeah. As you say, it's really hard to know what's going on. So this is the UK, the HMRC payrolls, which is actually showing an 85,000 loss in April, but they revised the March figure from -67 to -5.
Yeah. Frankly, they should just report this with a bigger lag, because every single month they are just way off and then they're revised down. So I don't believe this -85,000 number at all. They'll revise it.
Yeah. Yeah, you're right. Citigroup Economic Surprise Index for the UK is actually, the surprise is on the positive side.
Kaboom.
And the Indeed job postings, basically it's continuing its inexorable decline. It makes you wonder whether actually what's the problem is Indeed as opposed to...
Well, I should also say that Indeed have laid off 10% of their global staff. So they are, globally, they're not seeing an increase in job hirings.
Yeah. Tricky, really. UK Indeed job postings, wage growth. That's interesting. Right. That's what I was saying. Actually, there's a 6%.
Yeah.
This is in line with inflation, but it's also in line with what I was. Sorry, with pay inflation. But it's also in line with what we're seeing as a business.
Yeah.
And
that's it's bad. Ticking back up in April. Yeah. Entirely for understandable reasons. Minimum wage has gone up by 9.8%. Now, hopefully after that it'll come down, but I just can't see any way the Bank of England can cut rates when wage growth is this strong.
Yeah, I agree. And then we have UK Trueflation, which is basically flat at 3%, has been for several months now.
Yeah. And
the, what's that now? ESR stand for, Keith?
National Institute of Economic and Social Research.
Thank you. It's forecast the UK GDP growth Q2 will be 0.6, which actually equates to nearly 3% per annum.
Yeah, absolutely. And okay, how does that square with falling job openings, people being laid off? Don't understand it.
No, good point. Okay, so the UK, so our imports are 90 and falling, and our exports are 90 and falling, and ex-precious metals, our exports are lower. So this is showing that we're not doing anything to improve our balance of trades deficit, isn't it?
Well, actually, both imports and exports are falling. And what I thought was really salutary about this chart is that how come GDP is rising? Because, we normally, the only time imports fall normally is when we as a country aren't doing very well and we're not consuming as much. And so if the economy were growing, you would expect both imports and exports to be growing, but they're not. They're
That's interesting. Is that pre-COVID, there was a trend, wasn't there? Okay, it was quite a broad trend, but that trend is just completely absent now.
Yeah,
completely absent. There isn't, as far as you can see, there isn't really a trend.
Yeah. So again, I don't understand if the UK economy is doing so well. How come we're trading less with the rest of the world?
And UK total employment unchanged since the pandemic at 33 million. I thought we added 3 million jobs since the pandemic, Keith.
Yeah, it depends which survey you read, basically.
Yeah. And UK total consumption has returned to the pre-pandemic levels, but as pointed out here, there is no growth trend.
Yeah.
It's flattened. So the UK economy is stagnating, but it's up 0.6% quarter on quarter.
Yeah. I find this just incomprehensible.
Yeah. UK GDP is up, UK employment is down, which means that productivity is clearly rising, but it's not.
But it's not. So, I mean, how does that work?
It doesn't.
Producing more with fewer employees, labor productivity has to be rising.
Yeah.
But it's not. So basically, all the UK stats, I just can't trust them. They're not internally consistent.
They're not, are they? Not at all. So I think a caveat to the UK summary is the data is inconsistent within itself. And inconsistent data is being published by the Statistics Office. So unemployment rose, job openings continue to fall, wage inflation, I would say, is undeniably sticky and problematic.
Yes. Yeah.
And clearly, we've got those inconsistencies that pointed out below. So it doesn't look like the UK economy is in a particularly good place. in regard to inflation. And that means interest rates, as Keith rightly points out, are unlikely to fall for a while yet.
Yeah, absolutely. And onto the EU. So not much data this week. We had the ZEW Economic Sentiment Index, which is, reminder, a survey of economists. They are more optimistic, and that is a pretty good number, actually.
Did you see, forgive me if you mention this later on, Keith, did you see that the one of the vice president of the ECB has come out and said that many European countries need to get their debt in order, otherwise there's going to because the debt levels are exposing them to significant potential harm in the event of disruption in the world economy.
Well, I completely agree. They won't do it, though, will they?
Because it sort of disappeared off the horizon, hasn't it? Or not just it's disappeared off the agenda, but actually, France is named as one of the culprits. So 12 of them, but actually, it's still a huge problem in the EU.
It is. France, we talked about this previously on the podcast. France has a systematic problem. It was running a huge deficit prior to the pandemic, and it's running the same now, like about 4% of GDP.
Yeah.
And so its debt is just continually rising. And so Macron has not, reformed the economy in any way, shape, or form.
No. So I always feel the EU data needs to be looked at with that, bearing that background in mind.
Yeah. Well, that's it. Everywhere, so they're going to need to rein in the fiscal, and that will mean slowing the economy. Now, they should be doing that when the economy is strong. In the case of the US, the size of the deficit is just totally inappropriate for the state of the economy. So employment change in Q1 was good, 0.3%. Industrial production numbers are now positive month on month. So it looks like EU industry has turned a corner and is now growing again. Year on year, that beat expectations at only -1%, but that will improve if the current trend continues. GDP growth, the second estimate for Q1, 0.4%, in line with expectations, but that's actually a decent number for the EU. So the EU economy does appear to be on the road to recovery. The Citigroup Economic Surprise Index for Europe is fading but remains positive. Now, we look at the job postings indices from Indeed, continuing to drift off. Wage growth, unlike in the UK, is certainly coming down. Same for France. Wage growth definitely coming down. So European wage growth is heading in the right direction, unlike British. Now, this is really interesting. This is the hours worked trend. Red line, the pink line, is Germany. It now has the lowest number of hours worked of any developed nation. But you also notice that there's a distinct step down since the pandemic, both for Germany and for the EU as a whole. That's the light blue line is the Netherlands. You see this general pattern. So a lot of the new jobs created must be part-time, although the German unions have also succeeded in reducing their working week from 38 to 35 weeks. So in summary, the European economy does appear to have bottomed. So industrial production is rising. Sentiment is certainly improving. The EU economy grew in Q1 and wages are falling, but labor markets still appear to be weakening. The great news for Europe is that inflation definitely seems to be on the right track, and unless something changes, it looks to me like the ECB is on track to start cutting next month. On to the US, Richard.
So US CPI month on month was down, better than expectations at 0.3%. Still equates to about 4% per annum.
Yep.
And there's US CPI year on year at 3.4% in April. So, question, is US CPI actually ticking up? Beginning to? We shall see.
Well, you certainly, if you look at that trend, there is no evidence it's coming down.
Exactly. Yeah. US core CPI month on month, 0.3%. So that core is dropping. It was in accordance with expectations. And this is year on year core CPI 3.6%. Do we have super core here?
Yeah. Well, I'll show you that in a second. The core definitely is on a downward slope.
Yes. And this is looking at the seasonal patterns of inflation. And so if it follows the same seasonal pattern, then that would suggest that from this point forward, inflation will decrease during this calendar year.
Yeah. So 70% of CPI components are below 2%.
Yeah.
But I mean, that doesn't help if the others are, really high. And frankly, we know they are.
Yeah.
So that's car insurance and shelter, which are huge weight.
Yeah. So the CPI, as Keith says, dominated by shelter. CPI is you can see that the big contributors there are core services, ex-shelter, and shelter, and a little bit for energy and a little bit for food, not very much. And as the usual suspects, car insurance and shelter are driving much of month-on-month inflation, but everybody has to pay it.
Yep, that's right. And the trouble is that shelter's lagging, and as we've talked about in some depth previously, motor insurance, I mean, that's a societal change. That is, partly it's inflation, but it's mainly people looking at their mobile phones while they're driving and having more crashes and more severe crashes. And so raising interest rates is going to have no effect on that whatsoever.
Yeah. That's a good point, Keith. In fact, God, the interest rates have gone up again. Bang.
Yeah.
So excluding shelter, inflation was relatively subdued. And you can see there's natural gas, interestingly, down nearly 3%. And you remember used vehicles in the pandemic were a huge contributor to, they went up by vast amounts, didn't they? Now they're continuing to decline. So, and up at the top, we've got gasoline and motor vehicle insurance and clothing, actually.
Yeah, well, the fall in natural gas is going to reverse itself, given recent rises in natural gas price in the US. We'll take you through that in due course.
And this is just showing motor insurance, the way that is skyrocketing.
Yeah.
Parking fees. Now, parking fees are going up because all local authorities in the UK and everywhere, they're cash strapped, and the motorist is an easy target.
Yeah, I know.
I know too. It's really irritating. And this is home insurance, which is showing a similar trend to car insurance.
Yeah. So the commentary is a lot of Americans are actually giving up on their home insurance. They can't afford it.
This is super core. So, what was it? Back in sort of nearly 2 years ago, it was around about 6.5%.
Yeah.
Dropped to 4%-ish. And now it's rising again. I think this is one of the things that's spooking the Fed.
But again, Richard, it's all blue bar. And the blue bar is transportation services, i.e. car insurance.
Yeah.
And frankly, that's not going to come down anytime soon. Goldman Sachs are forecasting that car insurance inflation will fall from its current, 20% plus to 7% by the end of the year. But over the second half of this year, you are still going to see very high prints from car insurance, keeping inflation high. But on this, so on shelter and car insurance, just those two components alone will keep inflation high. And I don't think certainly over the summer, you're not going to see the Fed cutting.
No, I think that's right, which suggests that the exuberance in the market may possibly be overdone, in the stock market may be overdone.
Yeah.
So if you use real-time shelter metrics, CPI is below 2%. I've discussed this many times in the past, that shelter is very much a lagging measure.
Yeah.
Okay, so to hit the 2% target within a year, bearing in mind the historic level, monthly CPI prints would need to average 0.1%. So it's
it ain't gonna happen, basically, is what this chart shows. You know, even 0.2% gets you
0.4%, which is only, as you say, at 0.1% above April's.
Yeah.
That takes you to 6% annualized inflation.
Yeah, absolutely.
So there are three calls: trimmed mean CPI ex food energy and trimmed mean annualized month on month. And showing the same thing, aren't they?
Yeah. Inflation is falling. Above all, Richard, in the US, wage growth is falling. As wage growth continues to fall, then the underlying cause of inflation is falling. But because of the way the US measures inflation through shelter, actually the headline numbers may not come down as much as you would like. More on that in a bit.
So sticky inflation is at 4.4% and is quite sticky at 4.4%.
Yeah, shame.
Slightly.
Yeah, not coming down. Basically, this is the Fed's problem in one chart.
Yeah.
You know, sticky inflation is sticky.
Yeah. US retail sales month on month. It's a bit of a naff reading, but 1 month doesn't make a problem, I would say. You have to see whether there's a trend evolving there.
Yeah. And again, you know, US GDP data has remained strong in April. So I'm actually suspicious of this number.
Yes. Yeah. US retail sales ex gas and autos, I mean, it is showing a big drop from from February and March. But again, it's only 1 month's reading. So
yeah, you know, weather, the timing of Easter.
Yeah. US retail sales year on year, better than expectations. So, but still on a gradual declining path.
So they're worse than expectations in April. 3 compared to 3.8.
Correct. Shall I do that again?
Yeah.
So US retail sales year on year worse than expectations and on a declining path gradually. So that's the question: is how strong is the US consumer if US retail sales are negative year on year? Question. And how are we starting to see real signs of the US economy slowing? Yeah,
well, you see, the US economy has been printing these enormous, you know, growth numbers. But actually, when you look at inflation adjusted retail sales, they're negative. So, you know, again, how strong is the US economy? What's the, you know, the consumers aren't seeing it.
Yeah. So US retail sales, you can see the trend there, the post-pandemic spike, and then the gradual downtrend, actually noisy downtrend from and then the retail sales. What's retail sales versus trend, Keith?
Well, the red line is the long-term trend. So
so it's just a shift bubble down.
Yeah, so it's kind of the excess sales basically compared to trend.
Sure. US PPI month on month. Consensus expectation was 0.3. The actual figure was 0.5. So that doesn't indicate that. Well, that's not going to be comforting to the Fed, is it? Because PPI would tend to feed through into the economy over the course of the next few months.
Yeah. PPI is factory gate inflation. Pause, have a read.
Yeah. And PPI year on year is in an uptrend.
Yeah. It's low, It's low, 2.2%, but it's definitely in an uptrend.
Yeah. And US core PPI month on month, 0.5.
Yeah, not
High.
good.
No. And core PPI year on year, 2.4. But again, you can see that quite clearly see that there is a beginning of an uptrend there.
Yeah.
And there's a good correlation between PPI and CPI. And so PPI has fallen a lot, but it is, as we've just seen, it's rising again. And this is the thick black line is actual what is the correlation between PPI and CPI. And so a rising PPI equals a rising CPI with a little bit of a delay.
Actually, I should say that this chart shows PCE inflation rather than CPI. But anyway, they'll be very highly correlated with CPI.
Yeah. US import prices, this is a bit of a shock, isn't it? 9%, 0.9%. Wow.
Yeah.
What's brought that about, I wonder?
Not good. Not good. So actually, the point of all these inflation numbers is that April, although CPI came down, the inputs like import prices, export prices, factory gate prices, they're all rising.
And those tariffs on China are going to be inflationary, aren't they?
Yep.
Import prices year on year look like they are on a tear, don't they?
Well, rising. I mean, the absolute number is quite low, but the trend is
alarming.
Yeah, is alarming.
US export prices pretty stable, really, 0.4%.
Well, 0.5% missing expectations. Not great.
Yeah. Export prices year on year, again, as Keith points out, still negative, but the trend is quite strongly inflationary.
Yeah.
If it continues. US manufacturing production month on month. This is quite a noisy series, isn't it, Keith?
Yeah. But again, just like the UK data, what the hell's going on? So April, we've seen the GDP now from the Atlanta Fed. They were estimating 4.4%. The US economy red hot, but then manufacturing production is actually in decline in April.
And year on year manufacturing production, actually, it's the last 2 years, it's year and a half been pretty flat to slightly negative.
Yeah.
That's month on month industrial production, which is basically flat in April and March. And industrial production year on year is negative in April, quite more so than expectations. And again, it's just on this very gradual downtrend.
Yeah. So, the US economy is meant to be red hot. That number's not a good number.
Yeah. The New York Fed manufacturing index, really noisy series, this, but not strong over the past year and a bit.
Yeah. But the point is, Richard, that, manufacturing, we thought we were in a cyclical upturn in the US, but actually doesn't look like it now.
No. And the Philadelphia manufacturing index, which had been climbing quite, it's a noise again, isn't it? So is that just part of the trend? But definitely below expectations. The Michigan Consumer Sentiment Index, really a sharp drop down.
Yeah.
Sharp drop down.
Took a bath. That's a big miss.
According to the biggest miss in the history of the survey. So that is that's an outlier, isn't it? Real outlier. And consumer expectations, also a big miss and a big drop. And same with consumer current conditions, big miss and a big drop. 1 year inflation expectations starting to rise. That again, it's a noisy downtrend. This might be part of the noisy downtrend. And 1 year inflation expectations, there's a range there, isn't there? And it's still within the range, but it's shooting up quite quickly.
Yeah, what seems to have happened this month is that the resurgence in inflation has spooked consumers.
Yeah.
They're worried about, further erosion in their buying power, and that's affected the mood. Now, of course, this can be, if this continues and they cut back on expenditure because they fear that they're going to need more savings, because then you can have a recession. You can create a self-fulfilling recession.
Yeah. The National Federation of Independent Businesses Business Optimism Survey, better than expectations,
Yeah.
but not in a good place. If you look at sort of 2015 to 2017, and then 2017 to 2019, it's worse, significantly worse than it was in those periods.
Yeah, but at the same time, Richard, we know the US economy has been growing great guns over the last year,
Yeah,
and the optimism index has been terrible. And that's because actually it's the big companies that are doing great. The small
yeah.
companies ain't doing so well.
And possibly everybody's expecting a recession, so that makes you more pessimistic if that's what you're
Mm.
expecting. And it hasn't happened, obviously. Employment intentions sub-index. This is planned next 3 months, and current job openings. So, but it's on a downtrend, isn't it? Both of those readings are on a downtrend from the post-COVID spike.
But they did tick up actually in April.
Yeah.
But the definitely downward trend.
Yeah. The housing market index is sort of bumping, I would say, bumping along the bottom at the moment. It was above expectations, but sorry, it was below expectations. But it's, we have a broad band of 30-ish to 6 to 55 or something. Building permits, though, that looks like it's out of that range, doesn't it? That's a big drop. Well, look, it's not particularly different to the consensus expectation, but it is actually quite a big drop. Housing starts a little bit worse than expectations, and the overall a slight downtrend, I think.
Yeah.
Easy data. And construction jobs not yet falling in line with building starts. So more likely to fall in line with a combination of building starts and finishes, aren't they?
Yeah. So currently, I mean, the continued growth in construction jobs has been pretty mystifying, really,
Yeah.
over the course of the last few months. I suppose there's been this tick up in completions, hasn't there? But housing starts have definitely fallen, and there's been no drop off in construction jobs. They've kept on climbing.
Yeah. Agreed. It's puzzling. So what do we need to explain here, Keith?
Okay, well, this just totally mystifies me. So there are two charts here. You're looking at the top chart, okay? So the yellow line is the median sale price per square foot of apartments in metropolitan areas in the US, okay? And since 4 years ago, that per square foot price is up 46%. How on earth are Americans affording to move house? I mean, why hasn't nobody can afford these? When you look at the salary percentiles, multiples of US houses, they're ridiculous. And I just don't understand how mortgage people are affording new houses in the US, given that we know the mortgage number of mortgages taken out is very low, but house builders still building loads of houses. How are the people who are buying these houses affording them, and where are they getting the money from? If anyone knows, please enlighten me.
I don't know, Keith. Johnson Redbook retail sales. Well, this is a bit of a contradiction to data we saw a little bit earlier.
Yeah, absolutely. So according to the retail sales number, April was negative year on year. Well, not according to the Johnson Redbook. So reminder, Johnson Redbook is same store sales, so department store sales mainly, mall stores year on year. So it's directly compares the same store, the revenue they're getting. It doesn't include new stores.
I mean, you could conceive, couldn't you, that, I mean, it's hard to work. It would have to be some, I don't know. I mean, if they had a lot of stores that had shut down, they would simply drop out of the
Yes,
stats.
that's true. But the other thing would be online. If you'd
Yeah,
had a huge drop in online, but
yeah,
you'd expect everything to be fairly correlated.
yeah. It doesn't really make sense, does it? 30-year mortgage rate is sticking in that sort of 7%, roughly 7% level, which is a lot higher than it was a few years ago. And the mortgage purchase index is still pretty low.
Yeah, dead, below post GFC levels.
Yeah.
So, but we know housing starts are fine. So, how are
Yeah.
people buying these things?
And house prices are fine.
Yeah.
US initial jobless claims. Okay, this chart is saying nothing to see here.
Yeah.
And US continuing jobless claims, this chart is also saying nothing to see here, in fact. So absolute jobless claim numbers are falling.
Yeah. So the number we report is the seasonally adjusted number. In absolute terms, jobless claims fall during the summer.
Mm.
As we talked about last week, if you ignore the seasonal adjustment and instead compare continuing claims in the US with their pre-COVID average, what you're looking at is the chart top right, then you'll see there's a definite upward shift. And jobless claims are now 12% above their pre-COVID average for this time of year. So it would seem that the jobs market in the US is slowing. There are loads of recession predictors that work on a rise in the unemployment rate. And no states in the US have crossed the 40 basis point rise in unemployment, which would signify the onset of recession. And normally you expect to see that a recession is sort of declared when 20% of states have crossed that threshold. Currently, none of them have.
So we're nowhere near a recession by that indicator.
Well, but the thing is, but when you look at, you have this hard line, you could have 39 states with, 39 basis point rise in unemployment. And then next month they will go over. So, we know that unemployment is rising.
So US Dallas weekly economic GDP estimate is down 1.7, down from last week.
Yeah, still an okay number, actually.
Yeah. Atlanta Fed GDP now for quarter two is 3.6%, which is definitely an okay number.
Yep, strong.
And the surprise index has gone negative.
Yeah. Yeah. US economy is surprising to the downside, as you've seen from this week's data.
And everyone's growth indices are surprising to the downside. So, and inflation is surprising to the upside.
Yeah. Stagflation, here we come.
So, indeed, again, is everywhere in the developed world, by the look of it. Indeed is posting declining jobs postings.
Yeah.
And the wage growth, interesting, in the US is actually only at 3.1%.
Yeah, that's good. You see, so that should feed through to lower inflation in the US. The UK is very much an outlier with its persistent wage growth.
Yeah. And the US true inflation is 2.3% and in a bumpy downtrend.
Yeah. Trouble is, they revise this chart every week, including the history, so it's quite
Then
unreliable.
it's not trueflation, is it? They shouldn't revise it
No, they shouldn't revise
because
it.
it's no longer trueflation now. Kansas City's Fed's labor market conditions index slight fall. Yeah.
Well, it actually rose slightly in April, but the trend is definitely downwards.
Yeah. And historically, there's been a good link between that figure, that measure, and unemployment. And that is suggesting that US unemployment might start to rise to catch up with the LMCI.
I've been predicting this for many months now, but I think it's going to happen.
It is looking a little bit like it, isn't it?
Yeah.
And here we are talking about the US debt levels. And it's adding $100,000 a second. Which is staggering, isn't it?
Oh, God.
Since March, 10 billion a day. And well, you can read the statistics, can't you? But basically, the US is in a mess. And this is the government spending as a percentage of GDP, which has, 23% is not high.
No. Yeah.
But the level of debt that they have incurred is extraordinary.
Yeah.
So CPI is a little bit soft, and they have got this inflationary problem in core, and they've got inflation appears to be rising in factory gate and imports, and certainly economic data. We've been around this cycle so many times. I'm reluctant to sort of to be too definitive about this, but we have seen economic data consistently looking better than we expected it to, and I say that seems to be moving now to it being not particularly good.
Yeah, and inflation's persistent, sadly. And on to China. So we had inflation numbers from China, and they were weaker than expected, coming in at 0.1% in April against expectation of 0.5%. Inflation in China is very weak. So no sign of strong excess demand. Well, given that they're investing hugely in manufacturing, is that terrible surprise? Producer price inflation, i.e. factory gate inflation, strongly negative year on year. So evidence that strong industrial growth in China is outstripping demand, I would say. Not good for profitability. Industrial production, strong. 6.7% in April, well above expectations, up on March. Retail sales, though, weakening, 2.3%, well below expectations, down on March. Fixed asset investment was also weak, 4.2% compared to expectations of 4.6%. New home prices, minus 3.1%, worse than expectations. Further evidence that the Chinese property sector is struggling. Loan growth flat at 9.6%, the lowest it's been for many years. Vehicle sales well above expectations, but down on March. The unemployment rate fell. Actually, that is to its lows for the cycle. This is exports, and you'll see in absolute terms, they're below COVID levels. And US imports from China, this is a really interesting chart. Pause and take a look. But basically, the tariffs do appear to have been effective in curtailing Chinese imports to the US. That's not great for inflation, actually, because Chinese goods are cheap. So this is non-performing loans in China. The bars, and that's the right-hand scale, are non-performing loans. Net interest margin, which is the line, is the left-hand scale. And you can see that Chinese non-performing loans are rising. Those almost certainly loans to the property sector in particular, but also local authorities, etc. And that is going to put increasing pressure on the Chinese banking system, whose net interest margin is falling while their bad loans are rising. Not a good combination for the financial system. So China's summary: industrial production is rising, unemployment is falling. The Chinese economy is surely doing well, but retail sales are falling, retail sales growth is falling, and house prices are falling. It's a command economy. It seems to be doing all right, but it's certainly not rebalancing. China is doubling down on increasing manufacturing capacity. And onto one chart, which is a cheat this week because it's not one chart. It's a whole series of charts on default rates and credit in the US. So the red line is credit card debt, which has shot up in the US, and the green line is the personal savings rate, which has fallen and is well below pre-pandemic levels. And we know that the interest charged on US credit cards is the interest rate charged is at an all-time high, and therefore that high credit card balance combined with record rates means rising delinquencies, now at their highest level since the GFC and rising quickly. Now, the New York Fed had a report out on this, and these are really quite frightening numbers. So the blue line at the top here is the percentage of US credit card holders who had maxed out their credit card last month and their default rate the following month. That is 35%. So a big number. If you maxed out your credit card last month, there's a 35% chance that you're in delinquency this month. And the share of customers who are maxed out is, although it dipped last month, that's a broadly rising trend. And the balance held by consumers who have maxed out is rising. And if we look at the wider loan market, you'll see delinquency rates on credit cards, the dark blue line, they're rising. And on auto loans, they're also rising. Other is rising, whatever that is. But there's very low delinquency rates on mortgages, although that also is rising, but from very low levels. So when we go through those charts, it's easy to get the impression that there's big problems developing in the US credit market. But I don't think that's true, because actually, when you look at overall household debt, it's low, much lower than it was pre-GFC and lower than it was pre-pandemic. And when you look at the various subcategories, you'll see even credit card debt is actually quite manageable compared to this pre-GFC period, although, of course, the interest rate's high. The absolute level of debt is not worrying. And overall delinquency rates are quite low. So this is very much an inequality story. That households at the lower end of the income spectrum are struggling. They're loading up on credit card debt because it's their last option and then defaulting. So we're seeing rising defaults for auto loans and credit cards. But overall, US households do not have very high rates of debt, and their default rate in entirety is quite low. And sadly, the rising default rate for low-paid workers, low-income workers, does not mean that the US economy will necessarily slow, because obviously they don't spend very much. The vast majority of the spending done in the US economy is higher up the income thresholds, and they are higher up the income echelons, and they are unaffected so far. And quickly onto US Social Security. So this is the US Social Security Trust Fund. And it is now spending more than it's bringing in. It's in drawdown. And if nothing's done, it's going to draw down actually really quickly and run out of money early next decade. So despite the fact the US is running a huge fiscal deficit, it's not paying into the Social Security Fund. Now, there's a lot that can be done. So you can raise taxes, you can lift the cap on earnings subject. So if you earn above $168,600, you don't pay into the Social Security Fund, raise the retirement age, etc., etc. But you've got to do something. Otherwise, the Social Security Fund is not going to be able to pay pensions within the next decade. So further evidence that the US is living well beyond its means. And on to rents, Richard.
Thanks, Keith. So the Zillow Rent Affordability Index is significantly above the pre-pandemic levels, and it's fairly level at the current level, isn't it? But the median salary is $59,000 less than what you not comfortably need to afford a typical rent.
Yeah.
Out of kilter.
So this chart shows in purple rental inflation minus 0.8%, but CPI rent shelter inflation is currently at 5.7%. And overall inflation this wasn't updated for last month, but 3.5%. So you see that, rental inflation is negative, CPI shelter, hugely positive, and it's lagging. So hopefully you would hope that falling rental inflation should mean CPI shelter keeps coming down in the coming months.
Yeah. This is a month-on-month change in the national rent index, and you can see that rents are still rising. Right in 2024, rents have really stopped rising again, and reduces their affordability clearly.
So what we've shown you so far is that rental inflation is low, but CPI shelter contains a huge chunk of owner's equivalent rent, which is what a US homeowner estimates he would have to pay to rent his house, his own house, the one he's living in. And that is highly correlated with the Case-Shiller house price index. And sadly, for the fight against inflation, the Case-Shiller house price index is heading back up. And so CPI shelter tends to follow the Case-Shiller house price index with a roughly 18-month lag. And that means if you do the calculations, then CPI shelter will start to rise again from the late summer. So not great. Further evidence that US inflation, as measured by the official statistics, is likely to be sticky. So rent is 7.7% of CPI. Owner's equivalent rent is 25.4% of CPI. This is the basket. And second home's 1.3%. So total, within the CPI basket, 34.4% of the components are related to the housing market. And owner's equivalent rent is the dominant one. And sadly, for the CPI statistic, rising house prices mean that CPI is likely to stay high. And in core CPI, shelter is an enormous 43%. So core CPI is going to have the same effect, but even worse.
And shelter CPI is yet to catch up with the change in rents since the pandemic. And so that's likely to continue to rise for quite a long time.
Yeah.
So we're suggesting really, Keith, that although it's overestimated, has an inappropriately high input into inflation now, in the future, the actual input into inflation is likely to be higher.
Yeah, so inflation is likely to be persistent in the US, basically. Yeah. The bottom line is that in order to get inflation down, the Fed needs to get the housing market under control as well as wages.
So we can summarize, can't we? CPI, shelter, as we've discussed many times, is a lagging indicator, and it should continue to fall for some time to come until it interacts with the currently rising house prices, which suggests that CPI will rise, shelter CPI will rise again in the second half of this year. So it's a tricky one to sort of factor into where inflation really is, but it suggests that whilst inflation measure should be lower at the moment, it's likely to be higher in the future.
Yeah. Okay, so as flagged last week, we're now going to do a long and I think important segment on what caused the post-pandemic inflation surge. And before I get going, thank you very much to our viewer, Mr. C Peckham, for his contribution to this, for writing in, and for actually teaching me a lot of stuff. And so he's made me change my view. Now, what prompted his email was that in a weekly a few weeks back, week 155, I reproduced this chart from the FT, and I quoted Martin Wolf, who was saying the core reason for the surge in inflation was fiscal largesse, leading to a sharp rise in nominal demand on both sides of the Atlantic. And what this chart shows is, well, it purports to show nominal demand. So that is, total spending in the economy. Yeah. And so what Martin Wolf is saying is that the total spending in the economy shot well above trend. And that is evidence of excess demand. Now, before we get going, remember how inflation started in the US, the UK, and the EU. Now, the blue line is the US, and you'll see inflation starts to pick up in the US in January 2021, and that is well before the surge in the EU and the UK. You'll see that the inflation in Europe is lagging behind the US really until the invasion of Ukraine, and then it catches up. Now, okay, what do we mean by domestic demand? So that is the sum of consumption, investment, and stock building expenditures, both private and government. And how do we measure that? Well, the thing is, it's a function of price. So it's the goods and services consumed by their price. And so when you go back to this chart, what you're measuring is the outcome, not the cause. If, for example, an oil price shock caused the oil price to double, so expenditure on oil would also double. But that doesn't mean demand for oil has doubled. That means there's been a supply shock. So these charts do not show evidence of excess demand. All they show is the price level has risen. Okay, so if we go back to basics and to the supply demand charts, so at any point in time, the market must be in equilibrium between demand and supply. So the supply curve goes from bottom left to top right, demand from top left to bottom right. And so as price increases, so supply should increase as manufacturers increase their production in return to higher prices. And as prices increase, demand should fall. So consumers want fewer goods at the higher price. Now, what happens when there's a supply shock is there's a one-off change in the supply curve. So for the same price, suppliers are unable to produce the same amount. They produce less. So the supply curve has shifted to the left. Suppliers are producing less at the same price. And so demand, the point of equilibrium, shifts left. Demand falls, the price rises. Demand shock is the opposite. So in the demand shock, supply remains unchanged and demand increases, and the new equilibrium point is an increase in quantity and an increase in price. So in a supply shock, you get an increase in price, but a fall in quantity. Demand shock, increase in price, rise in quantity of goods supplied. Now, reminder, in this case, we know that there's been various supply shocks. So this demand shock chart does not apply, because we also know that the S curve has shifted, so it's going to be a mess. So onto the supply shocks. Well, we've had, during the pandemic, a load of supply shocks. We had sharp spike in oil prices and gas prices, particularly in Europe. The pandemic supply disruptions interrupted food supplies, leading to a sharp rise in food prices. The supply chain disruptions around the world led to falling goods supplies during the pandemic. And of course, after the pandemic, led to early retirement and to long-term sickness. And so a fall in the participation rate and the fall in the number of people available for work. So you also had a labor supply shock. This is the oil price, and reminder that there was an oil price shock after the invasion of Ukraine on the 24th of February 2022. And there was particularly a gas price surge, which was very bad for the European economy. And we've talked about this extensively with reference to Germany and the cost of manufacturing or industrial production in Germany. But in order to cushion the blow to consumers' pockets from this huge surge in gas prices, governments throughout Europe initiated energy subsidies. And that is a good example of actually fiscal spending reducing inflation, because they capped the rise in energy prices. The US was also affected, but by the rise in natural gas, put to a much, much lower extent than in Europe. And this is food prices. They shot up enormously. This is an enormous rise in food prices between 2020 and 2022. That's like 50% rise in food prices. The rise in food prices and goods prices was caused by disrupted supply chains. When you look at what caused the disruption to the supply chain, it is primarily stockpiling due to price concerns. So manufacturers worried about supply chain disruptions, stockpiling inputs, and basically just shortages. So lots of employees off work, etc., and mandated disruptions to work patterns. People having to keep their distance, etc., just reduced capacity in the global supply chain, leading to fewer goods and food being shipped around the world. The point of this chart is it's not demand. Demand is the dark blue bars, no effect whatsoever. The supply chain stress is all caused by stockpiling and disruption. And this is early retirement in the US. post-pandemic, you saw a rise in retirement in the US, which is just not coming down. So lots of people left the workforce. And this is people who are not in work because of illness or injury, shot up post-COVID. So that's long COVID, taking people out of the workforce for an extended period. And all that can be seen in the labor force participation rate. Although, of course, in the US, you have had enormous net migration, most of it illegal, which is slightly offsets that negative labor shock. Okay, so those are the shocks. They would have had the effect of reducing the availability of goods and services. So was a rise in the price level inevitable? Well, actually, the answer is yes. Because unless you take account of food, unless people had cut back their consumption of food to offset the reduction in supply, then a rise in the food price was inevitable. And the same is true of gas and energy. Unless you'd had a huge depression where people eating 30% less food and consuming 30% less gas and oil, then the price level had to rise. So a reminder, in a supply shock, if you keep the quantity of goods equal, so you don't reduce consumption, your price is going to shoot up. And you actually have to reduce consumption a long way to keep the price level the same. And that would have involved a huge recession, frankly, or depression. Now, after that initial price shock, being a change in the price level, because we didn't eat 30% less food and we didn't consume 30% less energy. And frankly, the role of government is to try and maintain living standards. And so if we maintained our living standards, then a price shock, well, inflation was inevitable. And once you have inflation, then workers will demand higher wages to try and compensate themselves for that historic inflation. And so what we're seeing now is those secondary effects, and higher wages in turn then lead to more inflation, and you get this decaying feedback loop. But because it's not been a demand shock, it's been supply shock. As supply normalizes, so the economy should normalize. And if we look at what happened, you see this is real consumption. Consumption declined massively. Now, part of this was mandated, but there's no evidence of excess demand. Actual goods supplied have returned to trend in the US. In Europe, they haven't. There's a huge drop in consumption and it's going nowhere, far below its pre-pandemic trend. Same in the UK. If it had been a demand shock, all else being equal, you would have expected to see a rise in the quantity supplied. Now, that's not going to be true in this case because we know there have been loads of supply shocks. The fundamental point is that the rise in prices was inevitable given all the supply shocks. And the only way to avoid that would have been a depression. You'd have had to cut consumption, by food and energy, etc., by enormous amounts, which would have been totally socially unacceptable. And if you break down the causes of US inflation, then you see that goods here is actually only a small part of overall inflation at the peak, and most of goods consumption is consumables. Only a small part of goods consumption is durables and discretionary. And if you'd really cut down on goods consumption, how much effect on inflation would you have had? Actually, not very much. Now, so to give you an example of a supply shock in action, this is the price of used cars in the UK. Now, during the pandemic, obviously all of the manufacturing was disrupted, and so car production declined. People couldn't buy new cars. They turned to buying used cars. The stock of used cars didn't change, and so you had a big supply shock in the supply of cars. And as a result, the price shot up, but as the supply normalizes, prices coming back down. Now, I thought this was really interesting. This is the volume. And so you see that the volume of used car transactions in the UK in 2020, when the price was going through the roof, the volume was going down. And so that is absolute evidence of a supply shock. Price up, volume down. Now, what's also found interesting is in year 2, so the price has shot up in December in 2021, actually the volumes are rising. So that is evidence of what you normally see when price is rising and people can see further price rises in the future. They start buying now in expectation that prices will rise further in the future. So to summarize, and I'm going to try and get this right, Mr. C Peckham is very precise in his language, and I am not. So any mistakes I make are entirely due to me. So in his view, the primary cause of the current inflationary episode was a series of supply shocks caused by the pandemic and then the Russian invasion of Ukraine. Actually, we've had loads of supply shocks. Inflation was then an inevitable result of those supply shocks, unless consumers had drastically reduced eating and heating their homes. Government spending did not cause the high inflation of the period, or was not the primary cause of the high inflation. Energy subsidies were disinflationary. Demand exceeded supply because of the fall in supply, not because of government largesse leading to excess demand. There was no excess demand. And the only way to have avoided a rise in the price level would have been to have forced a fall in consumption, which would have been totally socially unacceptable. And the subsequent fall in inflation has mainly been caused just by an increase in supply chains normalizing. So at the end of all that, actually, I agree with him. I think that when you look at the supply shocks, a rise in the price level, the rise in inflation was absolutely inevitable. And what we're seeing now is, secondary effects, wages rising as workers try to compensate themselves for higher historic inflation. Now, I do think that money has a role. And next week, we will be talking about the role of money. But the role of money, I think, has been in accommodating the rise in the price level. And it was not the cause of the initial inflation. So, Richard, did that make sense? Any comments?
They made sense, Keith. This is going to sound, well, anyway. So I remember when probably February or March, 2020, wasn't it? The pandemic. Gosh. I remember saying to various people that this is going to be inflationary, and they all laughed at me. And I knew it was going to be inflationary for this very reason, that there was going to be real problems with supply. Now, I actually think we are moving into a demand shock inflationary period. And I think the next bout of inflation may be caused by a demand shock in raw materials.
Right.
So it's quite interesting in this context to sort of separate them out. So, yeah, I mean, it's my I mean, Martin Wolf does produce these sort of instant correlations and says, if you don't agree with me, then there's a problem and it's not my problem. He tends to have. I read one of his books once, which was utterly incomprehensible, but full of statements of economic dogma. So I'm not a fan of Martin Wolf, actually, although sometimes he says some interesting things. And I think that this is another example, actually, of where what's going on in an economy is incredibly complicated, and there's a tendency for economists to oversimplify what's happening, and then they get it wrong. So I think it's definitely interesting.
Well, I mean, that initial chart where he shows, the rise in nominal consumption and says that's due to excess demand. Well, I think, that's just wrong. It's not, that just shows that the price level's risen. It doesn't say anything about the cause. Anyway, big thank you to Mr. C Peckham for, actually, we had a very long and convoluted series of emails about this, but he absolutely convinced me in the end, and I hope I've explained that well. Now, next week, we'll be talking about the money supply, which we also had another long and convoluted email chain about. So
I'd be interested to hear that one, Keith.
Yeah, if you enjoyed this one, there's more coming next week. And on to good news. So this is US fisheries. And every year they do a report showing how many of their fisheries are being overfished. And actually, it's been in decline in recent years. So basically, the fishing industry is no longer overexploiting the oceans to the extent it was previously. And this year, the number of overfished fisheries is down to 21, and they've taken Atlantic mackerel and Gulf of Mexico snapper off the list. So they're no longer being overfished. So our US's husbanding of the ocean is improving.
Good.
And hopefully that can be extrapolated around the world.
I was chatting with a fisherman the other day down in Portsmouth, and because we were both cleaning our boats, which were out of the water at the time, and he was a fisherman, and he said that people catch tuna off the south coast now.
Really?
Yeah.
Wow.
They have to put it back. They're not allowed to keep it.
Oh. Do tuna feed on sewage, Richard? We could soon have, special sewage-eating tuna off the coast of Britain.
Consultancy to Thames water looms.
And onto equities, Richard.
Thank you, Keith. So the FTSE All World Equity Index up 0.2%, but more to the point, up 7.5% year to date, and a big climb since mid-April.
It has. Amazing.
And there's the FTSE All Share. Is the FTSE All Share at an all-time high?
Good question. I think it must be.
Yeah, I suspect it must be as well. Sharp rise.
Yeah, very good last month. Amazing.
Yeah. There's the Euro Stoxx 600, which is also doing well, up 9.4% year to date, and then 1.5% nearly last week. Yeah.
Again, mystified. I remain mystified.
Yeah, so the S&P 500 is firing on all cylinders, up 11% for the year to date, which is pretty damn good.
Yeah.
And the Nasdaq up the same amount. I mean, again, at very high levels now, but not showing any signs of rolling over.
Yeah, the chart this year illustrates very well the traditional seasonal pattern where the market dips as people have to meet their tax bill in April.
Yeah, that's a good point, Keith. There's the Russell 2000, only up 3.5% for the year.
Yeah, and actually this perfectly illustrates how the great mass of US companies are not doing that well. Yeah. And actually the small companies in particular are very pessimistic.
Yeah. There's the Hang Seng, which has been on a tear in just the last few weeks, up 14.4% now year to date, up 3% last week.
Yeah.
The topics, which is up 16% year to date. And part of that is due to the significant currency decline of the yen. And Bitcoin, sort of in a little bit of a downtrend, or consolidation, I think is the appropriate term here, Keith, isn't it? Bitcoin is consolidating, up 55% on the year.
Actually, before we move on, thank you to Rogue Trader. We had a chat on the Discord on Wednesday night, which was great fun, actually. And we were talking about the nature of money and Bitcoin. Frankly, we were all too old to be fans of Bitcoin. I think you need a younger, more gullible audience to be Anyway.
Okay, so there's the pound versus the dollar, still within that fairly broad range, bang in the middle of it, really. Likewise, the euro versus the dollar, and not surprisingly, the dollar index is in exactly the same place. So it's just within that broad band.
Yeah.
There's the VIX. One day the VIX will return to some high, super high level, and if you're clever, you'll grab it.
Yes, absolutely.
And fund managers reducing their cash positions, which means that they are buying stocks, presumably.
Yeah, buying bloody anything, no, getting off the fence.
Yeah.
Thank you to Jaw It for sending us that chart.
Stock buybacks in the US continuing to support the equity market, as they have done for many years.
Yeah.
And strong earnings surprise in Q1. So S&P 500 earnings surprised the upside at 7% above expectations.
Yeah.
So the US economy in Q1 was doing well.
Yes, absolutely.
As far as the S&P 500 were concerned, there we have the earnings growth outlook, which does look pretty toppy, doesn't it?
It does. I'm deeply, deeply skeptical, but I've been totally wrong so far. The market believes.
Yeah. And earnings expectations haven't gone through any sort of downgrade cycle. So with earnings expectations they are staying as they began at the beginning of the year. So
yeah, because normally analysts play this game, where they slowly walk their forecast down so that the companies can beat them.
Yeah. No need this year. So expectation of the Magnificent Seven earnings will slow down in the next year, but that'll be quarter as well. That'll be compensated by an increase in earnings in all the others. So basically the S&P 500 will continue to perform well on that thesis.
Yeah. Now I showed this chart last week, but I wanted to bring it back because when we look at the data in the US for the US economy, it definitely appears to be weakening. And so those light blue bars, which show the rest of the economy, X the Mag 7, having strong earnings growth in the latter half of the year, well, if current trends continue, that's in danger.
And so this is the ratio of the Magnificent Seven to the rest of the S&P. It's just on that uptrend there, still in the uptrend.
Yeah. You're seeing that it's like 1.2. It's like, so Mag 7 is worth 1.2 times the other 493.
Yeah. So yeah, if there's a soft landing, but who knows if there's going to be a soft landing?
Yeah. Well, bull markets, I mean, it's been a good big one already,
Yeah.
35%.
Yeah. And they got the British problem, haven't they? Thousands of stock have disappeared. There's a lot of delistings and so forth, and private equity buyouts.
Yeah. Yeah. Okay, thank you, Richard. On to commodities. So some quick summary. The energy complex generally weakish this week, although US natural gas prices are recovering strongly from their lows. Industrial metals really strong, led by copper, nickel, and zinc. We'll take you through the charts, or Richard will take you through those charts in due course. Precious metals also strong. Silver hit a new high for the year, going through the roof. Gold also strong. Okay, onto energy commodities. So this was Brent, and that was downish on the week, down 0.5%, up 9% year to date. WTI, similar pattern, up 11% year to date, but well down from recent peaks, both of them. We look at numbers relating to the oil market, you can kind of see why. Another build in the US last week. Crude production in the US was stable at 13.1 million barrels, by far the largest producer in the world. Baker Hughes rig count is drifting off, though. Interesting. These are Dutch natural gas futures, and the good news is the recent strong rise has stalled, and prices are down 1.6% last week. In the UK, they're down 3.2%. US natural gas futures, though, rose 8.7% last week and are now up on the year. So we're talking earlier about the supply-demand curves, and in the US, you've had a supply shock in the case of natural gas, in a positive supply shock, and that basically overwhelmed demand. But now all the power stations are switching to natural gas, and the excess is being used up. And the forecasts are by the end of the year, the excess inventories in the US, the excess storage, will all be used up. And it's then a question of whether US natural gas producers will start drilling again in excess, producing another supply surplus. But right now, they've cut back on production. This is coal, flat on the week, unchanged on the year. Uranium, drifting. So down 2.7% on the week, flat on the year. And if you look at the size of uranium ETFs, well, the punters like them. They've put a lot of money into uranium ETFs in the last few years. Okay, on to industrial metals, Richard.
Aluminium, actually, aluminium is doing quite well, isn't it? So, and there's cobalt, which is sort of declining stepwise function, and is still showing no signs of life. So there's copper. I mean, copper may be up 27% year to date. There's a long-term thesis on copper, which is there's a structural supply shortage because of the electrification of the world, which I believe to be correct. And then there's clearly a bit of a squeeze going on here in terms of a lot of speculators jumping into the market. And so this is looking at COMEX trades, which are at a record premium to the London Metal Exchange, which is very unusual, clearly.
Yeah.
You see from that data. So, so copper, I think, is a good investment thesis over the long term, but don't be sort of gulled into jumping in because it's moving higher now, because it's moving higher for a different reason. And as this shows, a lot of funds have piled into copper, so it's a hot thing. It doesn't take away the long-term structural thesis, I believe, but it just now is the time to be careful of it, I guess.
Yeah. So just to clarify, Richard, what appears to have happened is there's been a short squeeze on COMEX, and that's then sent the copper price up worldwide.
Yeah, indeed, yeah. And this is a chart showing how much copper we actually need. And if you look at where we are now, about 26 million tons, and the projected requirement is twice that in 2050. And it takes a good 10 years to bring a copper mine into production from the point at which you find the copper. Yeah. So there's an awful lot of discoveries that are going to have to be made to achieve that level of demand. And that's where possibly aluminium comes in as a substitute for copper at some point, because it is a substitute. It's not a great substitute, but there is some substitution by aluminium. And as the price of copper goes higher, then aluminium may see a substitution demand coming in.
Yeah. Frankly, I think they're going to start mining the ocean floors. We've talked about this before. There's a lot of copper, close to subsea volcanoes.
Yeah. And there's chromium, iron ore, lithium, neodymium is moving back up a bit now, isn't it?
Still down 11% on the year.
Yeah. Nickel is, we haven't charted to go far enough back to show the big short squeeze of a year or so ago, but nickel is climbing quite sharply now, up 26% year to date.
I'm mystified by this, Richard, because Indonesia are producing vast quantities of nickel, and all the commentary I've read is that nickel is going to be in surplus for years now. So, but still up 26% so far this year.
Yeah. Tin is having a very good time of it as well, up 28% this year. Ferrovanadium isn't. I think ferrovanadium really, for some reasons, yesterday's story. And zinc is having a little bit of a catch up, although it's only up 12% year to date. And precious metals, as Keith said earlier, having a very good period. So gold is up 16% year to date. Much of it on central bank demand. It has not the move in gold is not correlated to the dollar. It's correlated to, well, it's sort of correlated to people's concern about the dollar, the reserve currency status of the dollar, and the use of the US of the reserve currency as a weapon. And I think that is damaging the dollar. Significantly damaging the dollar, and the beneficiary of it is gold. Damaging the dollar's status as opposed to its price.
I think that's absolutely true.
So managed money futures positioning is remaining long in gold. And here we show the central bank buying is continuing at least the same rate it was in 2023. And bear in mind, not all central banks always tell you what they're buying at the time they're buying it. And this is showing Turkey, China, and India leading the way. I mean, Turkey's got this huge inflation problem, which it could fix by pegging its currency to, in some way, to gold. And it probably doesn't have enough gold to do that, would be my guess. China is trying to remove itself from the dollar arena and is converting slowly its dollar holdings into gold, as I suspect is India. Russia's already done it. And there we are. Kazakhstan may be a net seller of gold.
Well, the thing is, point of this chart, Richard, is that the gold market is very opaque. And so, ING is saying that Kazakhstan bought 15 tons of gold in Q1. And, where are they getting the data from? Yeah, but undoubtedly, central banks have been buyers.
Yeah. I think the data only really comes from either you can probably infer it by various complex analyses, or from what central banks tell you. Central banks won't tell you the truth because it's not in their interest to do so if they're in the process of buying it. So you then have to try and infer it. The chart showing that China purchases have dwindled in recent months, but I don't think it changes the thesis that there's big demand from the world's central banks. It's going to continue for some time to come.
Yeah, thank you to our new Discord member, Neo4J, for sending us all that.
And Russia hasn't yet been a buyer. I mean, I guess Russia has converted all of its treasury holdings to gold, or many of them. And of course, it can't sell any more of its treasury holdings because it's been barred from doing so. So its gold level, its gold stockpile is remaining constant. Although it does have gold mines, doesn't it? So presumably it's mining gold.
Well, it's probably, instead of buying gold, it's buying guns and ammunition all around the world.
Yeah, that's very true, Keith. Okay, so ETF holdings still in decline. There's two ways of looking at this. One is that retail is selling gold, and the other one is that actually big institutions are selling the ETF, and then they can harvest the gold from the institutions, from the ETFs. And I think that's probably what's been going on. It's not actually this decline in ETF holdings is due to the gold being harvested out of it by bullion banks and so forth. I'm not quite sure what that means in terms of do the ETFs hold as much gold as they have value, if you see what I mean. So silver up 23% year to date. And platinum has been in a long-term downtrend for a while now, but it is starting to perk up. There's rhodium, but its change happened earlier on in the year. And palladium is still at the bottom of its range, but I would say that the prognosis for the production of electric vehicles is slowing, and people's enthusiasm. I read today again in the FT that only 30%, or was it you who said it? I can't remember. 30% of Japanese car, it was Yuki earlier. 30% of Chinese car production is electric vehicles. The remainder is internal combustion. So, actually, I think that the pessimism surrounding the PGMs regarding catalytic converters has probably been overdone, and that there is going to be a sort of resumption in demand for these through application into catalytic converters, because we're not going to electrify vehicles as fast as the optimists claimed we would.
Yeah, and on that point, so this week, the World Platinum Council said that platinum was going to be in quite a big deficit this year.
Yeah.
But that would not necessarily lead to a rising platinum price, because during the pandemic, there was a lot of excess supply and there's loads of stockpiles to work through. But the ongoing supply-demand balance is more demand than supply. At some stage, platinum starts to pick up.
Yeah, that's interesting.
Okay, thank you, Richard. And on to rates. Hurrah! Rates came down. Good for me. God, I need it. So this is US yield curve shifted down decisively after CPI came in soft. But bond guru Bill Gross thinks that basically the US is selling so many treasuries that the US is in danger of a Liz Truss style sell-off, and you should avoid bonds in the future. I hope he's wrong. But actually, there is no sign at all of the US yield curve shifting higher because of concerns about supply and the market not being able to absorb supply. What has been really striking about the US yield curve is how well anchored it has remained to interest rates. And soft economic data does appear to be pulling the 10-year yield lower again. Now, Richard was talking earlier about China and how it's buying gold. Well, it's been selling its treasuries. The US has basically overplayed its hand, I think, with sanctions and seizing foreigners' treasury holdings. And so now, if you have anything but a super friendly relationship with the US, you are wary of buying treasuries. Okay, so this is the UK 2-year, which is at 4.3%, still high. 10-year, 4%. 30-year, 4.6%. These are weird. That's a big number. So going forward, if bond yields stay this high, interest rates stay this high, then a lot of the people who've taken out mortgages at 2% during the pandemic, their ongoing mortgage costs are going to be systematically higher. This is the US 10-year, down from recent peak, but still high. German bond yield not coming down, actually. I'm expecting the ECB start cutting rates next month in June. Italian, Greek. Okay, concluding comments. Well, the data on the UK economy is just totally contradictory. Is the UK economy growing or slowing? So the GDP numbers, are surprisingly good, and the UK economy seems to be doing fine. But then, if that's true, how come we're losing jobs? We're shedding jobs. Anyway, wage growth is sadly persistent, and that means I can't see the Bank of England cutting interest rates anytime soon. Notice, though, that despite the persistence in UK wage growth, UK bond yields fell in line with US yields. UK yields are not doing their own thing. They're not reflecting the UK economy. They're reflecting the US economy currently. The US economy data over the recent few weeks is definitely softening, and that may yet mean a slowdown in the US economy, which allows the Fed to cut rates. But shelter inflation, as we've been through, is likely to mean headline CPI numbers stay higher for longer, making the Fed's task more difficult. But just the mere hint of low interest rates means that risk assets of all kinds and commodities are off to the races. Richard, how are you doing? You must be doing really well.
Yeah, I'm doing reasonably well, as you might expect from the movement in the price of precious metals. So yeah, that's good. I have made a couple of additions to my portfolio. I bought Sibanye Stillwater on the basis Platinum Group Metals may be in for a much better period of price than is currently expected. So it's also at a bit of a low in terms of, if you look at its chart, it's just a low. So I did that, and then I also bought the Sprott Junior Uranium Miners, which is actually a relatively new ETF. I think it's been around for about a year, and that on the basis that the uranium market is going to go considerably higher over the next few years. And one thing I'm considering is whether to invest in US natural gas, because I think the demand for US natural gas is going to go up very substantially. Your point, Keith, about are they then going to open up new sources of supply, and will that put a lid on the price, is a good question.
Honestly, I think they are.
Yeah.
There's, the thing is, the trouble with the US gas market is much of it's a byproduct from the Permian. And so people drill for oil and they get loads of gas. And so, I think actually the US is likely to remain in structural oversupply of gas. But at the same time, you are increasing, got all these LNG export terminals opening up.
Yeah.
Mid this, actually pretty soon, mid this year.
Yeah.
So, let's see.
Yeah, and whether there'll be sort of price arbitrage effectively between the US and Europe once they fully open. And the other point I think is that there's going to be a significant increase in energy consumption, but nuclear can't fulfill that need for 10 years realistically, because of the time it takes to bring them on. And what's going to fill the gap? And if there is a gap, that's likely to be filled by gas, which would be increase in internal consumption.
Yeah, but while we're talking about that, during the day, the loads of solar is being added, and so the great thing about gas is you can turn it on quite easily in the evening.
Yeah.
So you'd expect coal to be a big loser.
So anyway, that's my portfolio. Well, it's on my portfolio. It's where I am, and what I'm thinking. How about you, Keith?
Yeah, you're not upgrading your boat yet. Maybe buy a second one. You like Roman
I,
Abramovich. You
I
need a
did have
second yacht just behind,
I
in
did
case.
I did have my Genoa washed the other day.
Hmm, washed with gold.
No, washed with, I presume I didn't wash it myself. Enormous washing machine.
Well, okay. Well, what about me? Well, I'm doing shit, and I got this totally wrong. It's a good job there are two of us on here, Richard. People, can listen to you and ignore me. So I'm still down 6% on the year. Had a much better week as interest rate rallies. I mean, the thing about bonds in the is that you get everything will be tax free if and when I get out of this, and the yield, because you're making a capital gain on gilts there, that is not taxed. Now, this is the long-term chart of T68, and we are here. And frankly, I was expecting it previously to get back to somewhere here. If we get a recession and a sharp drop in interest rates, I could still get out of this trade alive. As it is, it's been a total disaster. But it's taught me a lot. And in due course, I will do a my worst trade on this. Now, what I wanted to talk about was the how you value these. So this is an index-linked gilt T68, expires in 2068. It has implied inflation of 3.4% and then an expected real yield on top of that of 1.05% as measured by Yield GIMP today. Now, I was asked the implied inflation of 3.4%. Do I do better? Does this bond, the index-linked bond, outperform then if inflation is higher than that? Answer, a very definite no. Okay, so that the implied inflation is what it says, implied inflation. If inflation were to be higher, then interest rates and bond yields would rise, which would mean that the price of this treasury, this gilt, would collapse. So actually, because you're playing for capital gain, what you want is lower interest rate expectations and lower inflation expectations. So although it's an index-linked gilt, you want lower inflation for this to rise in price. Higher inflation you'd be protected against if you held it to maturity, but if you want to sell it in the market, you need lower inflation. Now, if we talk about traditional gilts, this is a yield curve, and you'll see there is this dip down in the yield curve at TG61. Now, why is that? That is because when we talk about gilts and the attraction being that capital gains are tax-free, if you look at TG61, so what's remarkable about TG61 is the coupon interest rate on the bond is 0.5%. So if you buy, so every year you get 50p for the £100 worth of TG61 you hold at par. Okay. And that means most of the return you get is in the form of a capital gain as the bond heads towards maturity in 2061 and the capital is returned at £100. Now you buy that bond in the market as of yesterday at £30.62, and in 2061 you'll get £100. So that tripling in its value over the next 40 years, roughly, is entirely tax-free. And so for private investors, the fact that most of the return comes in the form of capital gains is very attractive, and hence they're paying up for it, and hence you get a lower yield than if you bought the bonds to either side, which have higher coupons. And finally, now last week I was talking about my angel investment portfolio, and I was moaning about, how I basically cut back on my angel investing because I was frustrated with the lack of reporting. And I mentioned how one of our startups had, they're in the shareholders agreement, they agree to give you like monthly updates. Well, they then don't do it because they don't need to. You own what, 0.5% of the company, and once they've got your money, you're nothing but a nuisance who asks them for information, and they don't provide the updates that are mandated by the shareholder agreement. What are you going to do? You're not going to sue them. You moan and they ignore you, or they do this. And so this is a screenshot of the relevant section from the monthly updates from one of our investments. It was the least informative piece of paper you've ever seen. Strategy, green, market, green. So I used to read these. They used to make my blood pressure boil as the total contempt they had for us. And that little yellow dot, which says investment, that means, oh, we'd like you to give us some more money while providing no information whatsoever. So thank you to Mark S on the Discord who edited this. And I thought, yeah.
It's critical. None of your business.
None of your business. Yeah, precisely. So, yeah. Hence, if the angel investment that Richard is CFO of, if that pays out, then this has all been worth it. But I mean, we met angel investing, and you're meant to enjoy the journey. And frankly, I haven't enjoyed the journey on enough of them. It's been going on for a hell of a long time now, this journey.
Yeah, it's arduous, isn't it, Keith?
Yeah. So just getting some money out, just getting some information out is just painful.
Never mind the money, yeah.
Yeah. And on that note, it's great to have Richard back. Hopefully normal service next week as well. In the meantime, I hope you're doing well in these exuberant markets. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.